contrarian investing. As the name suggests, it is absolutely following a strategy of going against the current views of the majority investors. It is basically taking a contrary view and invest in a stock which many others are not preferring to invest. But why do such investors take a contrary view? The answer is simple. They believe that certain consensus among investors can lead to wide mispricings in securities markets. For example, a widespread negative news or rumors about a stock may send the prices of that stock crashing. The contrarian investors try to spot such stocks and invest in it, resulting in above average returns. The goal of a contrarian investor is to profit from the mispricings that an irrational market creates. Contrarian investing approach relies more on market sentiments and investor behavior. It works because of the psychology of the market participants. During the beginning of a trend, the buyers are cautious and the more seasoned players are the primary participants. As the trend gains traction, more and more investors become aware of it, deploying more capital to take advantage of the market strength. Then at the end of the trend, when everyone who is interested in buying into the trend already had, with no more available capital to sustain the already inflated prices, it's incredibly easy for a panic to make stock prices tumble down. A perfect example of this was the 2008 market crash. The trend started and it continued till all those who were interested in buying into the trend has put in their money. Then stocks sold off hard, all the seasoned players made money and the crowd was left with stocks purchased at higher prices. The prices of stocks tumbled and the crowd, unable to hold on, sold their stocks, suffering heavy financial loss. At this point, this smart guys step in again and then dramatically the stock regains much of that lost ground in 2010. This was a classic case of the crowd dramatically shifting sentiment. Those who thought opposite to what the crowd thought would have definitely made a lot of money. However, the major question is, does it work in Indian markets where emotions play an important role? Yes, sentiments play a key role in Indian markets where investors often believe in horoscopes and palm reading to invest. The strategy of contrarian investing works in most markets. Contrarian investing focuses on looking at companies with a long-term potential who are out of favor either because they are misunderstood or because their short-term expected performance is below market expectations, or there is short-term negative news flow which is clouding the otherwise strong potential of the business. So where emotions and expectations are high, contrarian approach works well. The crowd will always be caught on the wrong side and when the market turns upside down. However, spotting those market turns is a challenge. According to the experts, these turning points could be spotted by studying the general economic indicators. Valuation is one of the concepts to understand the market turning point. The stocks should be bought when they are fundamentally cheap and sold when they are expensive. But valuation is slightly a tougher process and it requires a strong understanding of fundamental analysis. Another way for contrarians is to use technical analysis to spot reversals. Momentum, trend breaks, volumes, RSI all come into play here. There is another way too. This is nothing but skips looking directly at a securities price and looks at broader economic indicators such as volatility index to spot turnarounds. Tracking these indicators, not only one of them but all of them together, may help you take a contrary position before the market starts to correct itself. Successful contrarians realize that turning points are key. So investors, understand the turning points and you can be successful contrarian investors. A Venkatraman's report, TD News.